The first is that you may have seen that Korea, Japan, and China are now talking about forming some sort of super Asian, East Asian group, as it were. And I think that's fascinating because, this is something which was actually quite unlikely. You would have thought this was very, very unlikely as little as a few months back. But no, they're saying, okay, America is not, we've got to have a plan B because America is not actually doing us any favors whatsoever. And when you get, South Korea and Japan aligning with China as opposed to America, this is a shift in tectonic plates, and it should not be ignored. But the interesting thing is that they're putting correlations in there which are not that old. I mean, if you actually go back to the 70s, you disprove the one correlation which everybody says, and that is higher interest rates are bad for gold. I mean, hold on. In 1970, the Fed funds rate was something like 6%. It went down to 3 and a bit percent shortly after 1970. Don't hold me to a precise date, but it's something like 72, 73. And it went out at the end of the decade at something like 19%, and where was gold? Gold went from $35 to 850. The point they miss is that it's the dollar going down. It's paper currencies unanchored to real legal money, legal in common law. It's not anchored to that, so it loses its purchasing power. And it loses its purchasing power for two reasons. Firstly, governments have no discipline over its deployment. And the second thing is that its value actually becomes a matter purely of trust. That's it. And when the public lose trust in it, which they do over time, you then find that the paper currency just eventually goes down to zero. And I mean, if you look at it in British terms, as late as 1932, you could exchange one sovereign for one of those paper pound notes. You could submit it to the Bank of England or your bank and get a sovereign. That was before our last attempt at a gold standard was. But now, what's the rate? It's something like 590 paper pounds to one sovereign. That is an indication. That just clearly tells you what has happened to paper money. Not gold, because gold over long periods of time basically retains its purchasing power. It'll vary a bit depending what you're comparing it against. I mean, gold versus copper, gold versus oil, gold versus wholesale price index, whatever that might be, and so on and so forth. It's, it sort of just goes along like that and has done for millennia. But really, it's the currencies going down. And when everybody actually understands that, then those currencies, the fiat currencies, are doomed. It really is as simple as that. But the first people to understand it are always the foreigners. They will sell your currency if they feel that its purchasing power is going down. And particularly if the value of the assets, the underlying assets which they buy, because, you don't actually sit on dollar notes. Basically it's a bank deposit, it's treasury bonds, it's corporate bonds, it's equities. You've got all those things, financial things that you can put it into as a foreigner. And when those things start looking not quite so clever, then they start selling. And this, I think, is what we're beginning to see with the dollar. I mean, I think, President Trump perhaps has unwittingly upset the foreigners' view of the dollar, if you like, because that thing, trust, is really being undermined because the foreigners don't trust President Trump. The first is that you may have seen that Korea, Japan, and China are now talking about forming some sort of super Asian, East Asian group, as it were. And I think that's fascinating because, this is something which was actually quite unlikely. You would have thought this was very, very unlikely as little as a few months back. But No, they're saying, okay, America is not, we've got to have a plan B because America is not actually doing us any favors whatsoever. And when you get, South Korea and Japan aligning with China as opposed to America, this is a shift in tectonic plates, and it should not be ignored. I think that's the first thing I'd say. The second thing I've detected, talking more about BRICS, is the African nations are beginning to look at their resources a lot more seriously. And they're also looking at gold. I think that this is all part of, if you like, an appreciation that the Western financial system is actually in great difficulties. And not only that, but the Western financial system has done the African currencies no favors whatsoever. I mean, you just got to say, oh, that's an emerging economy. And, you could just almost imagine the credibility of the currency just sinking on the back of that statement. It's okay. A lot of it is mismanagement, monetary mismanagement. I mean, Zimbabwe's a prime case of that. Quite a lot of it is past mismanagement and the legacy of that. But these guys, I think, are coming round. I mean, I've been actually asked to go and talk to one central bank. I won't mention names, but I think it's worth notice. I mean, the fact that they're now beginning to consider these matters very, very seriously, I think, is extremely important. And I have no doubt that the thoughts amongst BRICS members about their future monetary policy, given that the anchor of the dollar may no longer be appropriate. I think this is a major, major change in everything, and I think it's accelerating. I'm not saying that it necessarily leads to everybody ditching the dollar and all the rest of it. I mean, that I think would be an extreme statement, and I have no justification in making it. But what I would say is that we're seeing the credibility of the dollar internationally being gradually eroded. And so from the point of view of investors, investors in the West, I mean, how do you protect yourself against that? Well, the answer basically is only one thing. You sell dollars, but do you sell them for sterling? Whoops, no, I don't think so. Do you sell them for euros? Oh, I don't think so. Yen? No. I mean, they're all in the same boat. So I think it's the fiat currency thing is a race to the bottom at the moment through our own mismanagement, simply. So from the point of view of investors, I think the only place they can really go to is precious metals, and particularly gold. Follow what the central banks are doing. The central banks are accumulating gold. Why? Because you've got to understand that what they're doing actually is selling dollars. And I think that's the biggest bit of a steer you can get, if you like, from the people who really know what's going on. I think there's also another problem in the background on this one, and that is that central bankers talk to each other. So when we talk about how BRICS and how the Asians may be regarding this, the central banks I'm talking about, don't think for one moment that our Western central banks are unaware of this. Apart from anything else, every 2 months, central bankers get together at the Bank of International Settlements, and under Chatham House rules, they talk to each other. They also talk to each other, if you like, independently. So what's happening, if you like, in terms of gold reserves is well understood the whole way across the central banking network. Now, in the past, we know that gold has been leased by central banks to the market, originally as part of the carry trade, whereby it was sold into the market and the proceeds invested in US T-bills, and it was an extremely lucrative business, which is why it was such a huge business, if you like, back until about the turn of the century. And Frank Venerosa reckoned that anything between 10 and 16,000 tons, 16,000 tons being half the total central bank declared gold reserves at the time. was, as he put it, adorning the necks of Asian women, because once they were sold into the market, it didn't really come back. I think quite a lot of it actually ended up in China, but that's another story. So it's not germane. It's not germane to what we're talking about. Then we had undoubtedly the book entry transfer system, whereby central banks storing gold for other central banks, like the Bank of England, like the New York Fed, would merely reallocate leased gold from central bank A to commercial enterprise B, and so the gold would actually remain there. The difference was that it's being double counted, if you like, as far as the market is concerned. Now, if I was a central banker, I would be saying, I don't want to lease my gold anymore. Now, what this does, and if I'm right in this, what this does is it reduces the liquidity for the paper markets, because it's this extra leased gold which is so desperately important to provide the liquidity in the overall, forwards, and also, by implication, the COMEX, which is why we saw so much gold going out of the Bank of England. A lot of that was, I'm sure, was central bank gold leased by commercial parties, and the commercial parties acting on the legality of their position with the lease. So it goes out. Now, here am I, central banker, Bank of England, storing my gold. I've been earning some, bucks or pounds or euros or whatever, leasing this out to other parties, knowing that it's going to stay in the bank, so it's going to come back to me eventually and all the rest. And I start thinking, hold on, it's no longer staying in the bank. I actually don't want to do this anymore. I think this is going to create a real squeeze in the markets, which we have yet to see. All we have seen, and I'd be interested in your thoughts on this, all we have seen is we have seen the liquidity in other centers sucked out and transferred into New York for whatever reasons, whether it's, the big boys, if you like, building positions so that they can supply the market at higher prices, or whatever. The situation, I think, is that we're going to see central bank leasing is not going to be renewed. The double counting, if you like, of reserves is going to lead into a crisis, and the crisis will be reflected in all derivative markets. And if it happens in gold, it happens across the whole system. For those who perhaps don't know the background to that, I mean, when Germany requested its gold back, I mean, this was after negotiations. I mean, they were refused I think the right to visit their own property, effectively. Then there would have been behind the scenes negotiations, and what we ended up with was an agreement whereby 300 tons out of, I don't know how, I can't remember how much they had, over 1,000 tons, I think, in New York Fed. Only 300 tons was going to take 7 years to deliver. 7 whole years. And so that was so embarrassing. It really was. And what was returned didn't match up in terms of the bar numbers, if you like, that the Bundesbank had in its original records. So, there's obviously something rather odd going on here. Having been so badly embarrassed by this, the Fed actually returned gold a lot more quickly than the 7 years. And then the Dutch decided, hold on a minute, what's our position? We want ours back. And so they had all theirs returned. I think it was something like 1,000 tons. I mean, it was a bigger amount than they got. So this begs the question: whose gold did they actually raid in order to satisfy the demands of the Dutch and the Germans? Someone else's, most likely, and that leaves even more of a hole, if you like, in the New York Fed's position. I mean, all this sort of thing. I mean, I think it was Warren Buffett who sort of says, when the tide goes out, you see who's not wearing the trousers or the swimming trunks. And I'm afraid that the way in which the whole system has been working for the last I don't know, centuries, or not centuries, but decades, is beginning to unravel. And that's actually very, very serious. And, when you get a contracting, particularly when it leads to a contracting derivative market, then what happens is you find that there will be casualties, and that's going to have to be handled. So we live in interesting times. Well, that's what we're seeing at the moment. Going back to market action over recent days, I mean, we when I wake up at say 6 o'clock in the morning and I look at the price, or 2 o'clock in the morning and I see the price, it's up, it's up, it's up, it's up. And about 6:30, they start banging it in Europe because Europe is an hour ahead of us, so 6:30, 7:30 their time. I think that's probably about when the dealers, if you like, in Switzerland and wherever, sort of wake up and think, oh my God, look, this is going the wrong way for us. We better do something about it, or whatever. I mean, I'm actually less, I'm less of a conspiracy theorist over that, because look, I've been in markets. I know that if you're a powerful force in the markets, then you move it your way. Yep. And basically you do it when you can see that people have, if you like, are out on a bit of a limb, and you hit them. Yeah. So look, that's markets. That happens all the time. This isn't conspiracy. That's just plain fact. But I think that it's the withdrawal liquidity, and I think what you're saying about the Bank of International Settlements I think is desperately important. Key point: if the Bank of International Settlements decides to square its books, sit up, take notice, work out what it actually means. Does it mean you should be in there short? I don't think so.